Hello and welcome to another Nedbank Private Wealth Investment Report. This is the third show that we broadcast live from our studios here in London. And we know we've got viewers joining us from all over the world. So it's fantastic that you've been able to join us wherever you may be. So let's get on with the show. Coming up, we're going to be welcoming back Head of Wealth Management, David McFadyen, who will be reviewing 2023 and giving us his insights on what 2024 might bring. Then it'll be over to Senior Wealth Planner Adrian Crowe, who will be sharing the top 5 reasons why he believes everybody should have a wealth plan and how that can help give you a prosperous future. Chief Investment Officer Tom Caddick and Head of Investment Proposition James Robertson will be here to explain what's going on in the markets and how they are managing your investments as a result. And then we're going to be joined by Director of the Quest for Legitimacy and Family Business Advisor Russell Hayworth and Head of Business Development Andrew Simpson. And they're going to be looking at how it isn't necessarily always easy to be part of a family where the older generation is highly successful or prominent, and the challenges that the next generation can face as a result. Very interesting. And then investment counsellor Rebecca Cretney will be sharing the personal benefits that she believes there are to philanthropic giving. And finally, David, Tom and James will be answering your questions live, so make sure you send in anything you'd like to ask them throughout the show using the panel on your screen. But first off, I'm joined once again by David McFadyen, and it's lovely to have you back with us, David. And I can't believe it's December already. It's just whizzed by. Where has the year gone, and how has 2023 been?
Well, it's great to be back here, Gemma. Thanks for that welcome. I think every year I get another year older and the year goes faster every time. There's so many things I could talk about in 2023. It's almost like how long have I got? But let me try and just keep it short. Maybe some personal highlights for me at Nedbank Private Wealth. I think the first thing I'll probably mention is we've won quite a few awards this year, which is really great to see. It's not really about the awards themselves; it's just that recognition.
It is about
external.
The awards.
It could be, but external validation from for the work and the dedication and the professionalism that our teams really put in serving our clients. So I think actually in a previous show, Simon Prescott, our head of wealth planning, was here with our award for Total Wealth Planning from PAM for high net worth individuals. I don't think Simon has actually put down the award since he won it. He carries it around with him everywhere, so that was a great success. Also here in the UK, we won the City of London Wealth Management Awards for the Best Private Bank, and that was for the 9th year running.
Wow.
Almost unbelievable, so hopefully we can make that 10. In the Middle East, we won the Wealth Briefing MENA Awards for Best Private Bank Overall Client Service, and that was for the 3rd year running. And actually in Jersey, where I live, our head of private banking, Cameron Walker, won the award for Best Private Banker of the Year, Isle of Man and Channel Islands. So, a few awards, I say it's not really about the awards, or maybe it is, but actually it's about the validation it gives for the people in the team. So that would be one thing. I think, secondly, just maybe some client experience enhancements we've made in the business. Not all of these are, life-changing, but just a little 1% improvements that we make. So, for example, we've improved accessibility on our website for visually impaired people, which is, really important for them. We've made it easier for clients who are based in South Africa to transfer cash or assets on our app to their international accounts. Again, a little tweak that's made life easier. And also, in terms of client experience, on our app now, clients can understand and see information about their individual investment holdings, which can be, quite useful for some clients. A particular highlight for me, of course, is welcoming new clients to Nedbank Private Wealth. I've had the opportunity to actually do that personally for some of them, not everyone obviously, but welcoming new clients has been a real highlight for 2023. And of course, alongside that comes new members of staff, and particularly client-facing staff. And as you said, we're going to hear from Adrian Crowe, who's our Senior Wealth Planner. He's one of those new hires, joined the London team this year. I'd probably finish on a couple of maybe technological type enhancements, digital enhancements. We've really revamped and had a completely different approach to how we produce videos and really social media in general. So we've really tried to take a much more punchy approach, shorts, I think they're called on YouTube. You probably know better than me, but little short videos, trying to be jargon free and just trying to educate and inform in a way that people can easily assimilate. And then finally, I'm really looking forward before Christmas, opening my Advent calendar and seeing the launch of our new website. So I think we're actually going to see a few shots of that on the screen. But it's completely redesigned. Not only is it easier to navigate, which is important, obviously, but it now has a section specifically for clients. And I just think it looks really wonderful. So looking forward to that. I'm sure it's coming before Christmas, so watch this space.
Wonderful. So like a nice rebranding, relaunch. Exactly. Sounds like a lot of positive tweaks there, quite big tweaks as well. And you might need a bigger trophy cabinet as well in 2024. So you need to put that on the Advent calendar too.
Let's hope so.
Now, I think we spoke last time about how 2023 hasn't been a particularly easy year for investors anywhere across the board. So how have Nedbank Private Wealth specifically helped clients weather the sort of particular storms that have been happening?
Yes, well, it definitely hasn't been an easy year. And Tom and James will probably talk later about some of the specific things that we've done in our portfolios. I think at a portfolio level, just the main point I would make is that we are absolutely committed to remaining very diversified in our portfolios. So an all-weather portfolio, you might call it, so weathering the storm, but also very liquid. And what that really means is that we invest in things that we can easily sell, either to get out of trouble or to take advantage of opportunities that are there. So when the weather changes, to use the analogy. I think for me though, the key is the communication that we have with our clients, because every client's different, every client's circumstances are different. And it's important that we empathize with our clients and not just say, well, don't worry about it, it'll all be okay in the end. So really empathize with clients, understand where they're coming from, and try and encourage them to think about the big picture. There's lots of continual bad news, it seems, whether it's mainstream media, social media, whatever. Open up your laptop or just watch the TV or newspapers. We try and encourage clients to differentiate sort of the noise around them from perhaps real sort of signals in the market where we might make changes. We recognise that there are headwinds to investment performance, of course, but there are also some tailwinds and opportunities out there. So definitely communication really is key for me. And I would things like this event are part of that communication. We also hold live investment seminars. So this year we have one in Jersey, one in London, and one in the Isle of Man. But there's no substitute for a in-person or Teams or face-to-face one-to-one conversation. So I would encourage any clients to get in touch with their private banker, however they want to do that, email or phone or whatever, and have a conversation.
Very interesting. Yes, because it can be unsettling, can't it? When the news is bleak. So I suppose it's that reassurance and those check-ins as well. Yeah. So what's to come and what is exciting you when you look ahead?
Well, so I'm going to sound a little bit geeky here, which is not
we like a geek.
Not my
That's
intention.
fine.
But one of the things that's really exciting me about next year is that we have started on the journey to totally replace our investment and banking technology platform.
Okay.
So I say it sounds a little bit geeky, but it's not, again, a bit like the award, it's not about the platform, it's about what that enables us to do and the sort of how it helps our clients and actually how it helps our staff. So that's not a sort of happens overnight program, but over the next sort of year to 18 months, we'll be putting in a new technology platform. And yes, it is geeky, but it's also exciting. So looking forward to that. I think in markets, and again, Tom and James will talk about this in some detail, we're certainly going to continue to see uncertainty, but uncertainty does provide opportunity. So I think that's exciting. Last time I was here, I actually spoke about some of the mega trends that we're seeing in the world. So whether that's demographic change or sustainable investing, technology, including AI, and even in the short time since I was last here, the sort of rise of AI, as it were, has just almost been phenomenal. So we're already investing in that in our portfolios, but there'll be much more of that to come in 2024 and beyond. So that's kind of exciting. There's a bit of excitement just around continuing to do what we do. So just continuing to service our clients. That's what they really value, that more than ever, actually, with sort of uncertainty.
It's that sort of pragmatism, isn't it? It's adapting all the time to what's happening.
Yeah, and just that constant communication. That's one of the benefits that I hope that clients see from an institution like Nedbank Private Wealth. And in fact, just maybe a final thing. We've just had the results of our client experience survey. So that's the first time we've really surveyed all our clients for a couple of years. We haven't really got all the detail on that yet, but maybe a couple of things to mention would be our net promoter score, which is a bit of a technical term. The best way I can describe it is the percentage of our clients who would actively recommend us to their colleagues, their friends, or whatever, has really gone up quite dramatically. So that's great to see, because client surveys are they're great to understand what you're doing well, but also what you're not doing quite so well. And one thing perhaps we're not doing quite so well from the survey is explaining to our clients what we're doing in the field of sort of ethical and sustainable investment. So that's a sort of action point for us to look at next year, and we'll certainly be actioning that.
So that feedback from clients is really important then.
I mean, it's everything really. We really appreciate when clients take the time and the effort to give us feedback, as I say, whether it's good or bad, because that's what we're here for. Our purpose actually in Nedbank is to protect our clients, to advise them with integrity, and to make their life easier. It sounds like a slogan, but it's not. It's what we're here for. So really appreciate that. That's
why you keep winning those awards as well. So it does sound like another very busy year ahead. And you never know, we might see more trophies in the studio here in 2024. So thank you very much, David. That was really interesting, as always. And you will see links to the Nedbank Private Wealth YouTube channel and the LinkedIn page in the platform so that you can consume all that great educational content that David mentioned earlier. And that gives me a great segue to hand over to Senior Wealth Planner Adrian Crowe, who's going to cover the top 5 reasons why you really do need a wealth plan.
I'm Adrian, and I'm a Senior Wealth Planner at Nedbank Private Wealth. The role of the wealth planning team at the bank is to help you achieve your financial goals through the creation of a clearly defined strategy for your wealth. We help simplify the complex and help you in an easy step-by-step way get from where you are to where you want to be. So who is a wealth plan for? Well, it can be for everyone, no matter how old or young you are, or at what stage of life you are. Our goal is to help you provide the right solution for you at the right point in time. These are my top 5 reasons for why you should have a wealth plan. Number 1 is control. A plan gives you control because it allows you to clearly understand what your financial position is, why your money's invested, with whom and how. We spend time listening carefully and intently to your current circumstances, your future objectives, goals and aspirations over the short, medium and long term. We help by analysing your financial position, and then we try to create a bespoke plan for you, showing improvements and optimisation and demonstrating through prudent planning how you can achieve your goals, whether it's for your wealth to remain secure for you, your family or your future generations. The second reason is purpose. A plan provides a purpose to wealth that allows you to identify your financial commitments and prepare for them. It provides a roadmap for achieving these goals by outlining the steps, timelines and resources needed. This might include areas such as financial planning to help you achieve your financial goals and aspirations, wealth structuring by recommending the most appropriate solutions for you and your family to minimise your tax liabilities. It might include retirement planning to help provide a comfortable future to achieve the life that you want to live. Or it could include succession planning so that there's an efficient transfer of wealth to the next generation. Or if you're looking to relocate, then relocation planning to help you understand the impact of moving to the UK or overseas. The third reason is to achieve goals. It improves your ability to achieve your goals by assessing your current circumstances and forecasting your future wealth, along with your income and your expenditure. Where shortfalls occur, it can help identify ways in which that gap can be bridged. The most common goal people have is for planning for retirement. For many, those who are at the beginning of their career, their goal is to retire as early as possible. After assessing what they might want retirement to look like for them, what they wish and can afford to set aside to achieve this, our cash flow analysis will help them to understand what the value of their income might be in retirement and whether this matches their aspiration or whether something needs to be reconsidered. Reason number 4 is peace of mind. A wealth plan can provide peace of mind that you have a clearly defined strategy for your wealth, giving you the psychological comfort and helping manage emotions by providing a structured and rational approach to your financial goals and well-being, helping you get from where you are to where you want to be. We also work closely with your other professional advisors, whether that's your tax advisor, legal advisor, or your investment manager. Consequently, there's a joined-up approach across your professional network, almost creating a quasi-family office, and you can be secure in the knowledge that whatever your circumstances, your team all knows what the others are doing, and they're all pulling in the same direction. Lastly, reason number 5 is to make you wealthier. Ultimately, a wealth plan should make you and your family wealthier, monetarily or emotionally. Of course, once we've put a plan together, that's not the end. One thing that's certain is that things change, circumstances change, tax legislation changes, and investment performance will vary. Therefore, it's important that you review your plan so that you ensure that you remain on track with your plan, or if needed, amendments can be made. So to sum up, having a wealth plan and working with a team of professional advisors will help you meet your financial goals and aspirations and help you achieve the life that you want to live.
Thank you, Adrian. Compelling reasons there on why we should all think about getting a wealth plan. Right, joining me in the studio now is Tom Caddick, Chief Investment Officer, and James Robertson, Head of Investment Proposition. And they're going to give us their insight into what's happening around the world and how that is influencing the investment team's portfolio management. So, Tom, lovely to have you back again, familiar face. And James, your first time joining us. So welcome to the show.
Hello.
And I'm going to start with you, please, James. So, Head of Investment Proposition. It's a great title. I like it. It sounds very swanky. It's good. But what does it mean? Can you enlighten us in terms of what your role is?
Sure, of course. So, well, we have a range of investment options that I look after.
Yeah.
And part of that is putting those investment ideas and recommendations into action in clients' portfolios and getting those orders to the market. Another big part of what I do is looking at the design of our investment options, which is making sure that we've got the right toolkit to meet our clients' needs. A big part of that is also is listening to client feedback to influence that decision making.
Okay, so that said, what are you hearing from clients, sort of specifically at the moment? What kind of thing? What's the mood like?
Yeah, well, so we get feedback all the time from clients via their conversations they have with their advisors, as well as the client survey that David mentioned earlier. We have with the clients have been talking a lot about geopolitical concerns and conflicts around the world. A lot of headline grabbing news, of course.
Yep.
So it's very natural that they're talking to their advisors about that, and they're natural to be concerned about it. They're expressing a lot of interest in sort of ethical issues, interested in investing sustainably, which is something that we can do. So that's obviously a very good conversation for us to be having with them. And they're also talking about cash quite a lot, because cash looks like it might be quite an attractive alternative to investing at the moment, given that rates are quite high.
Yeah.
Although that comes with a risk that might be a short-term phenomenon, and they might miss the longer-term investment opportunities if they're in cash rather than investing at the time.
Okay, so that's really interesting. Thank you. And just picking up on that, you mentioned sort of geopolitical landscape. It's not been a very easy year, has it, for investors across the board? Would you say?
I would agree.
You would agree.
and I'll be the last person who's going to turn up here and say, woe is me, how challenging this has been. Because really, it's been the clients, and we know it's been a challenging time for the last sort of 18 months in terms of capital markets and returns. I mean, I think if we think about the year that we've had so far and the way it started, I think you'd be forgiven for thinking markets got off to a really strong start in January and February of this year when we saw a big sort of rally in equity markets. But actually, it was quite thin. And by that, I mean, it was confined to only about 7 stocks, ridiculously.
Okay, yeah.
Often dubbed the Magnificent Seven. It's sort of Microsoft, Apple, Nvidia, Meta, and the like in the US. They make up a very large proportion of the index and have driven things. So I sort of think of the year up to probably the end of October as being dominated by that early strength, and then dominated by a number of key themes. Number one, inflation, for sure.
Yeah.
And that's been a major theme, a big narrative within the markets generally, this year and last.
Yeah.
And what we've seen is inflation peak. It's gone to sort of levels that people haven't seen for sort of 30 years or so. And the big concern is what to do about it. So clearly it was central banks. Their main tool through monetary policy is base rates.
Yeah. Was there 14 hikes or something, wasn't there?
It was something like that.
Something like that.
Exactly. We've seen that in the UK with the Bank of England, the Fed in the US. We've seen the Central Bank of European Central Bank all taking a fairly aggressive stance, trying to bring inflation down, but walking a very fine line. Because if you try to bring inflation down through monetary policy, i.e. through base rates, really what you're trying to do is to slow growth. But you don't want to slow growth too much. And that's been the challenge because it has had a knock-on effect. You've seen growth rates in the economies coming down, and the big concern, that sort of wall of worry, has been how will central banks manage this, bring inflation down, but not snuff out growth?
Yeah.
And that's been the big challenge that we've seen.
Yeah.
Now, I said about end of October, so that takes us to the end of October, where actually, apart from the Magnificent Seven, we saw very little activity, really. It was just oscillating markets, a lot of concern that we'd be sliding into a recessionary environment. Stocks had moved sideways. We've not seen the strength that we were expecting. What we've seen since then has been a sharp rally. So since the end of October, going effectively November, we saw one of the biggest rallies we've seen in 30 years in bonds, in fixed income. Equity markets, we saw much more broad strength globally. And so that's been a much better time for investors.
Some relief.
Yeah, some relief.
That's really good to hear. And so what have you been doing against that sort of admittedly rather gloomy backdrop that you can't do anything about?
Yeah. So, I mean, we took a position for clients really at the turn of the year, going into the back end of last year, and we've maintained that within equities, which is favouring what we call quality growth. So those are the areas that maybe stand up better in a more recessionary or slower growth environment. Yeah. The likes of Microsoft, actually, is a great example of that. Quite high barriers to entry, well protected, good income stream, should do well in a recessionary environment or a non-recessionary environment. So that sort of positioning within the equity space. We did also like fixed income, where we were adding to government bonds, those sorts of areas where we were quite happy to take on some of that risk for clients because we believe that we're moving into an environment where that should do well. Okay. What about yourself, James?
Well, over the previous time, it's been quite tricky for clients. 2022 was very difficult, and most of 2023 so far. Hopefully, they're feeling a little bit of respite from the rally in November.
Yeah.
But we've done a lot of work with clients, taking them back to the conversations we had with them before we put the portfolios into place for them, in the financial planning we did with them. We're able to show them this is the kind of difficult markets that we expect will happen at some point. You don't know exactly when, but this is just one of those times, and your plan is robust and is built for it. So that was a big part of the preparation that really helped them.
Excellent. So that real reassurance. And it's interesting because it can be easy to forget, I suppose, the sort of more human factors that go on behind the scenes. You know, people's
definitely.
emotions and anxieties and all of that and so on. But you clearly got a big team to help you with all of this.
Yeah. So there's that work the advisors do, and David was talking about, expressing empathy with clients. It could be, they might have things going on in their own lives. It can be an additional stressor if perhaps the portfolio doesn't look like it's doing exactly what they're expecting at that moment in time. But there's a lot of, I think there should be a lot of comfort to be gained from the fact that we've got a very robust process. We've got 3 teams, dedicated teams. Here we've got a team of investment analysts who are doing the research and monitoring all of the time. They come up with the recommendations. We have a team that manage the portfolios and translate those recommendations into the client portfolios, and another team that place the orders into the market and make sure that we get the best outcome at an individual order level for the clients. So those 3 really come together, and it's a very robust, rigorous process, provides a lot of control, which really I think should provide a lot of comfort for clients.
Yeah.
With looking after their portfolios.
When you explain it like that and the level of expertise at every single point of the process, there's a lot of protection there, isn't there? A lot of control.
Absolutely. I mean, we work in a controlled environment anyway.
Yeah.
I think, that's often a forgotten aspect. But yes, absolutely, it's about having specialists, highly qualified individuals. In fact, I invited James to attend our tactical asset allocation meeting yesterday, which I think he had that thrill of joining. But where we've got dedicated analysts presenting views and the data behind the economy.
Yeah, so this isn't just guesswork.
Not at all. No.
Because some people might sort of not understand that level of control that's going on in the background. So that is very good indeed, and bringing a lot of reassurance to clients it is a particularly sort of interesting time in the world, isn't it?
It is, and there are a number of challenges out there.
Yeah.
And clearly it has been a tough sort of 12 months or so. But where we, exactly as James has just been saying, it's about having confidence in the process. And I think just recently is a case in point. It's believing in the process that you have and knowing and understanding the work that's gone into that and the positioning that you've taken on behalf of clients. Yeah. And believing in that and holding true. Yeah. So capitulation is one of the worst things that one can do.
Panicking.
Yeah, no, well, absolutely. And we're paid not to do that.
Yeah.
But, going into the turn of the, in the end of October into November, and a number of the positions where, much like our fixed income position or with equities, for example, which in some cases hadn't played out as we had anticipated yet. It feels like we were a little too early in some of those positions. And I'm pleased to say that we were on the right side of that going into the rally that we saw.
Great. Yeah. Now, you actually mentioned earlier about fixed income. So can you explain a little bit about that, what that is?
It's, when we say fixed income, we're talking about debt.
Right.
Debt that is issued by either a corporate, so a company, and then bought by others who are effectively loaning to the company, or by governments. So by governments, we're talking treasuries, so T-bills or gilts for the UK, bunds for Germany. That's what we're talking about.
Got it.
Quite often called bonds.
Bonds, yeah, so bonds are back.
Bonds are back.
Okay. Explain a little bit more about why you are happy about that, and also why should everybody who's watching be happy about that?
So, I think when we think back to something that was called quantitative easing.
Yes.
So, often talked about and very often not understood, but that created an environment where we had super low interest rates, base rates. We had an artificially manipulated bond market, fixed income market, that was keeping the returns very, very low. And by returns, I mean the starting yield, what you would get paid for loaning. And the problem with that is when you have a very low starting yield, the bonds haven't really got anywhere to go. And that was the challenge for a portfolio. So quite often we might buy bonds, fixed income, for clients' portfolios to give a degree of insurance, protection, so that when you have challenging market conditions, you've got the stability of a bond or fixed income position.
Got it.
But under quantitative easing, it just wasn't giving that to you. So although the returns looked positive and strong. Reality was that they weren't giving you the yield. So for us, we had a big reset of 2022 where we did see some weakness in those markets. We've seen base rates climb. Your starting yield now is a much more attractive place. So that means that they will, and we should expect them to behave the way that traditionally we would want them to behave in a portfolio. So we can use them in that way. And what we've been doing within the portfolios is we've been reducing our exposure to corporate debt, so to companies, just because we don't feel like we need to take the risk for clients in the portfolios. But we've been buying government debt.
Okay.
So much safer, less risk to things like default. But we've been taking what's called interest rate risk. And the belief there is that if we start to see central banks reducing rates as we go in over the next year or two, not back to recent historic levels, but just slightly reducing those, having some of that exposure will be beneficial to portfolios.
Okay.
So a whistle-stop lesson in fixed income market.
And very clear. It was really interesting. Thank you. So let's go back to you, James. Looking ahead, what do you see 2024 bringing? I love that. It's like, get your psychic head on. I mean, I know there's a lot of things you can't determine, but what's your feeling?
Well, I know that clients would like to see some positive returns. Very difficult. 2022, unusual market. We know they happen from time to time. 2023 has been flat to the end of October, starting to look a bit more positive. I know for a fact we've got some great assets in the portfolios. There's assets in there with performance potential. We've got the fixed income element it's got a good yield, as Tom's been saying. So there's every reason to expect more positive returns through 2024. We think there'll be some volatility because we've got possibly a couple of sets of elections next year. Just one reason that we can anticipate that shows up in the crystal ball that could cause prices to move around a bit, but that might well also provide some opportunities for us.
It is going to be an interesting year ahead, isn't it? Anything you'd like to add on that?
No, I mean, I think James has captured it there, and I know David talked to this just now about the headwinds and the tailwinds, and those headwinds, geopolitical. You turn on the news and it dominates at the moment. We had the Russian invasion of Ukraine, and now the events in the Middle East, the fears around contagion, and it is easy to translate that into markets. In reality, there's always geopolitical events going on, and they do get drummed up by the media, and it's easy for that to then dominate your thinking.
Sure.
But the reality is that there are some positives. I mean, James was talking there about political risks, and actually I think there's about 42 meaningful elections next year.
42?
Globally.
Yeah, I was only thinking US and UK, but that's...
Exactly, India, I know China's got... there's a lot going on next year. Yeah. And that can create a bit of volatility, but it can also create opportunity.
Sure.
We have seen economic growth come down a bit, but actually what we're starting to see is some green shoots of potential for central banks to be able to manage that slowdown and not push into full-on recession. So although we've got that risk, I think we've got some hope there.
Sure.
I think the most important thing there is actually valuations look pretty good.
Great.
Be it on fixed income markets where your starting yield, as I said, is actually really attractive. But in equity markets where, apart from that magnificent 7 that I spoke to, valuations look good. So for us, we've got a lot of pent-up performance and pent-up returns ready to be realised.
Excellent. That's really good. Some green shoots of hope there as we go into a new year. So thank you very much, both of you. Really, really fascinating. And they are both going to be joining us for the live Q&A. So we'll see you again very soon indeed for that. I'm now joined by Nedbank Private Wealth's Andrew Simpson and Russ Hayworth, who is a family business advisor and director of the Quest for Legitimacy, which explores the unique experiences faced by people who come from backgrounds where their parents or their grandparents are really high achievers, highly successful, or perhaps particularly prominent. And unsurprisingly, this can bring a lot of pressure onto the rising generation And that is what we're going to explore a little bit more now. So Andrew and Russ, welcome. Andrew, give us a little bit of an overview on this. I think it's really fascinating, actually, in terms of the difference between where somebody's parents might have come from and the experiences of their children.
Yeah, I mean, the subject matter essentially focuses on the fact that a lot of people within that rising generation, the children within a successful family or prominent family, even though they've had a number of opportunity, huge opportunity provided for them, really do struggle with life. And in terms of why it's important to acknowledge that is a big part of the problem is that it's not spoken about and it's not communicated, and they have very different views on what that success means, whether you are the now generation, the sort of the people in the driving seat, or whether you're the rising generation, the children that are coming through behind them.
It's really interesting, isn't it? Because I suppose when you hear about successful people, often you hear about their humble roots, perhaps their working class background, and there's a lot of respect that goes hand in hand with sort of having been able to sort of crash through barriers, social mobility, if you like. So is that a problem for generations who are born into wealth? Because in a way, you're starting from a level that's very different. So where do you go?
Yeah, I mean, very often in terms of those people who are entrepreneurial, who start enterprises, start businesses that go on to become successful, that's come from some form of pain or trauma, for want of a better phrase, in terms of, I want to solve a problem, but I also want to be able to put food on the table.
Yeah.
The fact that it then grows and becomes something that has more significance and more prominence naturally means that any future generations that follow don't necessarily have those same experiences when they're growing up. That's not their fault. They didn't ask to be born into these families. But just as a nature of the success of their predecessors means that they're growing up in a completely different environment to those that the parents or grandparents would have grown up into as well.
Yeah, as you say, they can't possibly have that lived experience of, I want to get out of this situation, I want to change my circumstances. So what are the main challenges that these children sort of have to face?
So within our research, we spoke to 25 different rising generation members from around the globe. So what we saw were patterns that existed irrespective of where people were in terms of their geography. There were some cultural elements depending on part of the world that they came from, but some of the recurring themes that we found mainly was the presence of isolation. That feeling of, I'm on my own in this. I don't have anyone that I can talk to about the fact that I have all this opportunity, but often that can lead to a sense of overwhelm and a sense of, how do I navigate this? Because I'm in a very fortunate position. I think it's quite important to point out as well that it's not necessarily an inherently overall negative experience growing up in a prominent wealthy family. There's masses of opportunity and really positive elements that come from it. But what our research found is that there is also elements that creates that isolation and that feeling of, we had participants, for example, who were the wealthiest person in their particular social circle or in their particular class at school or whatever the sort of social group that they were in. And that brings its own challenges around, are they my friends because they're my friends, or are they my friends because of my kind of
because they want
prominence?
to use my swimming pool or whatever. Yeah, so there's that slight
Exactly.
paranoia perhaps. Yeah, that's understandable. And Andrew, does this just affect children of the very wealthy?
No, in fact, the book is focused on prominence, and with that, the wealth follows. During the last sort of year or so, when I've been speaking to Russ about this particular topic, and when I read the book, it was quite interesting because I was looking at characteristics or people that I grew up with whose parents weren't particularly wealthy, but the father may have been hugely academic, and my friend was not, and that was a huge pressure. And what it boils down to is that everyone is on some kind of quest for legitimacy, whether you're wealthy or not, but it has a real magnifying effect when it is from a family with huge wealth or huge prominence. And I think that's the point. So everyone is affected. It's just it becomes a much bigger effect with greater prominence.
It's really fascinating, isn't it? Because as you say, success and sort of wealth is often going to go hand in hand with having a big character for a mum or dad, a big personality. and will know, even if you've got children yourself, your children aren't necessarily like you at all. I've got two that are completely different, completely different DNA.
Yeah.
So I guess it's that assumption of, are your children going to have the same tools as you to sort of create? What do you think?
Yeah, and I think just touching a bit on Andrew's point around the use of the word prominence. So Jamie Weiner, who is the psychologist that I work with, who we did all the research, it was his kind of idea to do this research and bring it to fruition. He's the author of the book, The Quest for Legitimacy, and the subtitle of that is How Children of Prominent Families Discover Their Unique Place in the World.
Okay.
And we use the word prominence very deliberately.
Right.
Because wealth can create prominence, but also history can create prominence.
Got it.
One of our participants mentioned to us that they were delighted that we'd focused on the word achievement rather than wealth.
Yeah.
Because the wealth is often the result of the achievement.
Sure.
But it's the achievement itself. How do I live up to that achievement if perhaps I haven't had the same upbringing, or if I've had different opportunities, if I've been sent to different school systems than my parents had, then that in itself can create what we call the shadow, which again naturally has negative connotations, but the shadow can be inspiring in terms of how do I cast my own shadow, how do I get to that level of prominence myself. But there are others that find that quite intimidating, and we spoke to families that were 400 or 500 years old, and that legacy in itself, it wasn't a particular person, it was the achievement of the family before them that had created this prominence, that they were like, how do I live up to those expectations? How do I carry this legacy on?
Okay, and how does that sort of manifest itself? How does that play out? Does that mean that perhaps some children who've perhaps come from a very famous family historically or something, might they try and rebel because they're trying to plough their own furrow and sort of find their own identity? So I suppose every child has a choice, don't they? It's like following your parents' footsteps or create something completely different.
So again, in terms of the research, there was mixed kind of journeys. They all had a pattern.
Okay.
So all of our participants followed what we would term the 4 phases of the quest for legitimacy. So the first phase is a phase of awareness, where they become aware that perhaps they have more opportunity. For many of the people we spoke with, that awareness came in retrospect through the talking and discussing it. They look back and go, actually, I am aware of the fact it was different. A great example is a lady we spoke to whose family were a diamond dealing jewellery family, and she learnt to count at 5, 6 years old when her dad brought home diamonds and poured them on the table and helped her count.
Yeah.
Now looking back,
Most people have an abacus.
Absolutely. So looking back, she's able to go, wow, that's a moment of awareness for me that I've had a different upbringing to perhaps those that are around me. The second phase is then a tug of war, that pull between the world you're being brought up in and the outside world, and how you navigate that. The third phase is then what we've termed exploration. I think we'll come on to a bit more detail around the importance of that phase a little later on. But it's effectively, what do you do in order to find your own agency and your own sort of legitimacy? And that's where the fourth phase comes in, which is ownership. And importantly, we don't mean ownership of assets, we mean ownership of your own life.
Okay.
That feeling of legitimacy, that internal sense of agency, and it's non-linear. So you don't get to ownership, get a badge, and then you're legitimate for the rest of your life. You can be taken into any of those phases at any given time.
Okay, so it's just being comfortable in terms of where you're from and who you are. As you say, it's all an accident of birth, isn't it? It's very interesting. And I guess in many ways, it's quite a delicate subject as well, isn't it?
I think it's a very delicate subject if you've got 2 different generations in the same room and you start talking about it. It's not actually a very delicate subject. And we did an event recently where we brought clients along. From a rising gen perspective, it's not a delicate topic. It's actually a huge amount of relief when you start using the language that has come about from the book and the research. They start going, oh my word, this is such a relief that this is not a unique thing for me. This is very actually quite common for people in my situation. So there's a huge amount of relief, and you can see it on their faces. It's quite emotional, and we also, in this particular event, we had the now generation and the rising, and there was a real disconnect in terms of The rising generation felt huge relief that this was a topic and they could talk about it, whereas the now generation had no concept. All they saw was the opportunity that they'd provided.
Interesting.
Broadly speaking.
Yeah. I think this is so fascinating. I can totally understand why people might be thinking, I'm so glad you're saying this out loud. And I find that fascinating that as the now generation, they're like, well, I've worked really hard to give everything to you. And perhaps that generation are going, and I'm really grateful, but it doesn't come without its challenges.
Yeah,
That's so interesting.
To place that into a bit of context as well, what we believe is that the quest for legitimacy is universal. So it's not just limited to the rising generation. It just so happens we spoke to the rising generation. That has no age bracket. So the oldest person we spoke to within the 25 was 75 years old, and they would still consider themselves as rising because they hadn't got to that point of the prominence within their own family. But what we often find as well is that the now generation are unintentionally casting a shadow of expectation. It's not something they're deliberately setting up because they're on their own quest for legitimacy. They are looking at life going, I'm just trying to do the best I can every day to make something a success. They don't appreciate that those that are seeing that, particularly from a child-parent relationship, is kind of, wow, this person is a giant. They don't have any worries or concerns themselves. And now I've got this position where I've got to live up to those expectations.
Yeah.
And it's all unintentional. It's in the room, but nobody's talking about it.
Right.
And that's it. It's the lack of communication. That seems to be the biggest problem from my limited experience.
And I understand that that's exactly why this particular topic has generated a lot of interest from Nedbank private wealth clients.
Yeah, absolutely. You know what? A lot of our clients do fit into the sort of the category that were part of the research and the book. So absolutely, it's a fascinating topic, and it's one that's not really been spoken about.
Right. So, is there anything that we should be looking out for?
Yeah, absolutely. We off the back of some really interesting events we've done this year so far, we're looking to do a number of events with Russ, some of which we've spoken about, some of which I'm
Are you going on
hoping to
tour?
if Russ will. Yeah, so there's lots planned for this year coming up. It's a huge topic. We've barely scratched the surface, to be honest.
Yeah, interesting. I think it's fascinating, and it is probably not something that many of us would have really thought about before. But anything that gets people talking can't be a bad thing. So thank you so much to both of you. It was really, really interesting. Thank you.
Pleasure. Thank you.
Now, we are, of course, in the run-up to Christmas, the season of goodwill and gift-giving. So when would be a better time to talk about philanthropy? So I'm now going to hand over to investment counsellor Rebecca Cretney, who is going to talk to us about how it really can be as personally beneficial to give as it is to receive.
Thanks, Gemma. So why philanthropy? Well, philanthropy is giving one of these three things: your wealth, your time, or your talent. But why give anything at all? If this life is just 5 minutes, why not just eat, drink, and be merry, for tomorrow we die? Well, it turns out that the old adage about it being better to give than to receive is actually true when it comes to philanthropy, especially if you can somehow witness its impact. Here are 4 reasons drawn from client stories of why other clients have found that to be true. Philanthropy can and should be fun. One of our clients, who is a renowned inventor and philanthropist, once told us that he had done nothing out of a sense of duty or because he felt he had to, but because it was fun. That sense of deep engagement and fun that he got out of anything he pursued was a cornerstone to his entire life. He found the intersect between his passion and his talent and translated it into philanthropy projects he wanted to support and be involved in during his lifetime. He argued, why give only in your will? Where is the fun in that? I want to witness the effect that the projects I am involved in have on other people. Second, because it furthers your status. In the US, philanthropic giving is very much a social phenomenon, a way of networking and socializing. And it doesn't take close inspection to understand why. Like-minded people with like-minded values involved in fundraisers or in projects that speak to those values bring about a social club of sorts, where not only philanthropy flourishes, but for-profit business deals can also take place, because it can give you purpose. For many of us, retirement is a threat. It's easy to find a sense of purpose in work, and it becomes difficult to imagine a life without work. Many of our clients don't need to work. They have accumulated enough wealth to last for generations, but can't imagine losing that sense of purpose. Many of these same clients are highly educated individuals with impressive careers and experience, skills that charities are desperately in need of. So an amazing partnership can be born. They can and do end up joining boards of charities or employing their talent for the good of causes that move them. This leaves a lasting imprint, an intangible legacy which benefits both them and the charity or cause that they align themselves to. Many have said that this sense of purpose has made the post-retirement years far more rewarding than their actual career, because they can work on a passion project which has direct, tangible impact on people's lives, because it brings families together, united under a common purpose. Families can and do drift apart, but not if they're working together. A shared passion to do good can act like glue. Not only that, family foundations or jointly run charitable projects can also be a very effective means to educate younger generations in critical thinking and leadership, in effective financial management, or as a means of passing on some of your own core values. Nedbank Private Wealth can and do form a partnership with you in these educational projects. But the amazing thing is the effect that philanthropy has on the heart of the giver. It gives back. Philanthropists light up. They radiate that passion project. Reflect on your passions. What truly drives you? What causes or issues ignite your enthusiasm or fuel your sense of injustice? Your legacy can be deeply tied to the causes you care about the most, whether it's supporting education, environmental conservation, or community development. Align your efforts with your passions. It will enrich your life and the lives of others close to you. It can be part of your legacy to your family, particularly if it encompasses giving your time, energy, and passion. Philanthropy can be your gift to yourself and to future generations. If you're interested in exploring how we can help you with your philanthropic ambitions, or would like to examine how, from a practical perspective, the giving of your time, wealth, or talent would affect your financial future, please get in touch. We would love to join you in your philanthropic journey.
Thank you very much, Rebecca. Okay, I'm handing the reins over now to you, our viewers, and thank you so much to all of you who've sent in your questions. And there's still time to send yours in if you would like to do so. You can keep them coming in, and you can send them in via the panel on your screen. But for this, I need some people to answer the questions. So I'm going to welcome back David, Tom, and James. Right, let's start with Tom. Investment trusts clearly had a challenging year. What have you, and I say you, what have you all been doing about it?
I mean, it's undeniable. Investment trusts, which is a particular structure around some of the positions that we hold, have faced a really challenging time for the last sort of 12, 14 months or so. I won't go into the technicalities of it because it's quite boring, very interesting to me, but quite boring. But they have. The fundamental element is that the assets themselves remain really high quality.
Yeah.
So things like renewable energy that in fact have continued to go from strength to strength. We've got a position in infrastructure that has continued to increase in value. But the problem with investment trusts and the challenge, probably better to say, is that you have the actual value of the instrument, of the underlying portfolio, and then you have what the market is pricing it at.
Okay.
And what we've seen with investment trusts across the board over the last year has been that the market has priced down the value or the share price of those investment trusts, despite the fact that the net asset values, the value of the actual underlying instrument, the positions, remains really solid. So we continue to believe in the investment trusts. We are very cognizant of the fact that the market has priced them down. And what we're anticipating is a number of things. Well, what we've seen on one is that predators come in and actually just buy them out. We saw that on one of the positions where the share price moved 60% upwards in one day when they were bought out. This was Roundhill, when they were bought out. So that's one thing that could happen. You sometimes have investment trusts that where the underlying management will then actively try to bring that share price back up by buying back their own shares, reorganising the balance sheet on their book. Or then just the backdrop changes. And that's what we've seen over the last month, actually. So on a number, in fact, pretty much across the board on the investment trusts that we hold, we saw a movement in November of anything from sort of 5% to about 30% upwards.
Okay. Yeah.
Where the market started to adjust. So it's been a challenging time, but we continue to really actually believe strongly in the underlying assets.
Excellent, thank you. Okay, one for you, James. How influenced are you by the negative headlines when it comes to portfolio decisions?
The negative headlines? Not at all, I think is probably the best answer there. On a day-to-day basis, we are actioning client requests to take some money out of their portfolio or investing in new portfolios. So obviously in making those decisions, we're making a lot of careful decisions about how to place those orders. And in those cases, we're looking at what the market is doing in that particular instrument, but not the headlines there.
Yeah.
I think headlines feed in to wider considerations, which, as part of the investment analysts would be looking at through the research. But I think it's safe to say, Tom, not on a daily basis. You're looking at the longer time frames there.
Absolutely. I mean, the markets, be it equities, bonds, investment trusts, all of those, they are a forward pricing mechanism. They are pricing in future expectations. So the noise today we have to look through.
Yeah.
It's impossible to avoid it and to ignore it, but really it's about trying to decide on the direction of travel and how we can expect the economy and the backdrop, and importantly the markets, to move and to shape and change over a medium term to longer term.
I guess headlines can be very sort of misleading sometimes, can't they? They can be sort of screaming at you, and it's what's behind them that's often the nuanced, a bit more nuanced.
No, absolutely. With the geopolitical noise that we have in the background, it would be easy to draw a conclusion that you would just sell everything, go to cash, and that's it. And I think, what we saw in the back end of October into November is a case in point. Yeah. Where you saw a sharp movement, positive movement in equity markets, in the bond markets. Had you moved into cash at that point, prior to that, you would have lost out on that strong rally.
So it would have been a bit knee-jerk.
Yeah.
This is very much the strength of process that I was referring to earlier, and this is why we feel it's so important that strength of process is there, and it means that if a client sees these headlines, feel like they're being buffeted around, the portfolio values changing, that doesn't influence professional investors, and that's where the value comes through in the long term.
So, ignore the headlines. Okay, Tom, AI is the buzzword at the minute, but is that all it is? Is it all hype?
mean, I'm sure we've all got a view on that. I mean, I think from an investment standpoint, clearly it was a major driver for returns earlier in the year. And I think it would be safe to say, certainly, from what we have seen, and we've done quite a lot of work on this, it is a huge leap forward, particularly on the generative AI.
Yeah.
A huge leap forward in terms of the potential. But the way we're interpreting it from an investment standpoint is it's really about the productivity gains rather than necessarily any one single winner. Clearly, I spoke earlier about the Magnificent Seven and the likes of NVIDIA, really strong sort of beneficiaries of this sort of early phase in generative AI, but also likes of Microsoft, who have really been driving areas. That will settle down. I think it's about the potential for productivity gains across industries where there's some benefits.
Okay, right, let's get another question. David, I am thinking about getting a wealth plan, this one's for you, but may or may not sell my business in the next couple of years. So should I wait until after I've made that decision and then do a wealth plan? What do you think?
Well, I think the short answer is no. I think the whole point of a wealth plan is it's not a set in stone sort of fire and forget kind of thing. So it can certainly take into account and does take into account future changes in your circumstances, future changes in the environment. Certainly, our client could do a wealth plan perhaps with and without, and almost look at what the different consequences might be. But yeah, I would suggest doing one sooner rather than later, because one of the things, as we've mentioned earlier, that a wealth plan can do is give some level of comfort when what we've just been talking about, when the headlines are bad and it seems like you just want to sell everything and hide under the bed.
Live under the sea.
Exactly. A wealth plan, we build in to our wealth plans negative scenarios, prolonged market, dislocations, etc., etc. So I would encourage, really sooner rather than later. You don't have to have all the answers, to do a wealth plan. So absolutely.
Okay, next question is for Tom. What are you doing to maintain clients' wealth as the value of the US dollar declines significantly?
So obviously that's predicated around a view that the dollar is going to weaken. I think the answer to that, and I think probably James can chip in as well, is that it does depend on your base currency. I would say that the way in which we invest is globally. For all portfolios, we have a global view. And I'll try to avoid getting too technical about the hedging and the way in which we approach it, but we think about the assets that we have in two different ways. So when it comes to our equity exposure, we tend to actually embrace foreign exchange exposure. So that is part and parcel of the way in which those investments will play out over time. When it comes to things like fixed income, or what we describe as nominal assets, which generate a positive, a return in terms of income, we do tend to hedge those positions. But the level of hedging, and when I talk about hedging, I mean protecting against foreign exchange exposure versus your base currency.
Sure.
So the key question there is, what is your base currency? So if you have a starting currency that is dollar, then actually it's having foreign currency within your portfolio, if you have a weakening in dollar, will be beneficial.
Okay.
And it very much depends on what your starting point is, but we do hedge.
Okay.
Did you want to add to that?
I don't think there's very much to add really at all. We run the portfolios in sterling, dollars and euros, and we hedge those different currencies accordingly. If we also became of a very strong view that there was likely that the dollar could weaken, having the hedging separate in the portfolio to the actual assets also gives us the opportunity to take a view on that. So we have that opportunity to do that. Most of the time we don't do that unless it looks like a really surefire scenario.
I think the only thing I would add is if you don't know what your base currency is, it tends to be the currency where you're spending most of your spending most. So many clients have more than one base currency, so they may have a home in the UK and perhaps a home in the US. And we can cater for that as well. But just to kind of clarify, base currency is really where you do use the majority of the spending.
Got it. Okay, thank you. Right, we've got time for a couple of more, I think. So, Tom, what impact do you think the elections next year are going to have? I think we alluded recently there was 42 or something happening, but I'd imagine a lot of people will be thinking about US, UK.
Yeah, so I mean, there are a number of different scenarios. I think the main ones that you'd look to would be UK to a lesser extent, to be fair. We are global investors, but it can create noise. It can create some volatility in markets. In particular, what we saw, well, it's sort of October last year when we saw sort of Liz Truss coming in. That's an extreme example of sort of politics at its worst.
That was terrifying.
It was.
Yeah.
It was, the knock-on effect there. But broadly speaking, when you get the build-up, as we saw with the mini-budget, or the autumn statement coming from the UK government, where you start ahead of an election, you start to see positioning and posturing, trying to do things to sort of sweeten the electorate. I think the main ones will come out of the likes of India to a lesser extent, but it's an important one.
Yeah.
But the likes of US,
Yeah.
which it does dominate the narrative. Typically speaking, a Republican party are seen as sort of pro-market. Democrats not necessarily anti, but Republicans are sort of seen pro-capitalism. So it can have some impact on expectations, but it's around trying to read through that noise.
Yeah, interesting. Okay, David, somebody here has said, I have no idea when to retire. I think a lot of people feel like this. I love working, and would a wealth plan help me to decide at what age I could retire at least from a financial point of view?
Well, it certainly would help, yeah, absolutely. As we in our wealth plans, we assume that people live to age 100, right? Which is probably a little bit generous, at least for a middle-aged Scotsman like me. However, what it does show is perhaps when you might run out of money if you didn't invest, or if you spend too much. So it certainly can help. But I think retirement is much more than a financial decision. So I get the point. So yes, certainly financially, you could say, well, yes, I've got enough to live on, provided things don't change. Things do change, and as I said in the earlier answer, things might change in your circumstances. They might change in the sort of geopolitical circumstances, as we talked about, whether different governments might tax differently, etc., etc. But yeah, it certainly wouldn't hurt, and I really would. You can probably tell, encourage people to do a wealth plan as soon as possible.
Okay, right. Last question. It's going to you, James. What kind of performance are you seeing from sustainable portfolios?
Oh, yeah, interesting. So our sustainable portfolios have been performing really well. So we launched these just over a year and a half ago, and the returns have been very good. The returns, and what I mean by that is we expect our sustainable portfolios to have a similar return to our responsible portfolios over the long term. They have all the benefits of the same asset allocation process and robust process that our responsible portfolios have, and the same target returns. So over the long term, the return should be the same. In the short term, because they hold different assets, we do expect the returns to be a bit different.
Sure.
So, one might be a little bit ahead now, and in 6 months, the other one might be a little bit ahead if it was a race, but it isn't. The thing that makes me pleased about the way the returns have panned out is they're very similar, because the more similar they are, the better, because we expect them to have the same or similar return over the long term. The real reason to choose a sustainable portfolio versus a responsible portfolio is not performance related. It would be around the only reason really is because you want to think about the impact your investments are having on the world around you.
Yeah, absolutely. Look, thank you so much for sharing all of your knowledge. It's been really interesting, but I'm afraid that's all we've got time for. So we have covered a lot in the hour. David gave us his thoughts on what next year will bring. Adrian gave us 5 great reasons to start a wealth plan. Tom and James gave us an insightful overview of the markets, and Andrew and Russ helped us to understand the struggles of growing up in a prominent family, before Rebecca told us to be selfish and give. Thank you to all of our guests today, and thank you for joining us, and we look forward to seeing you again next time. Thank you.